Welcome participants to Marmore webinar series. This is Rajesh here. I work as an analyst with the Marmore. Marmore is a majority-owned subsidiary of Kuwait financial center Marcus. Established in 2010, Marmore has developed full-fledged research capabilities covering multiple areas such as infrastructure research, economic research, capital market studies, policy analysis, and the like. Focused on the MENA region, Marmore is focused on serving the interdisciplinary knowledge needs of its client and stakeholders. In today's webinar, I shall highlight the challenges in computing cost of capital for frontier and emerging countries and suggest ways to overcome the same. I shall run over a few examples to explain how WACC could be calculated for GCC countries in particular. Finally, I will also discuss about the cost of calculation for a private company. Questions, if any, could be asked anytime during the course of the webinar, and I shall try to address the same at the end of the presentation. Recording of the presentation will be sent in a day or two, and the same shall also be uploaded in the Marmore website and the YouTube channel. Alternatively, you could also email the questions to my mail ID, which is rdeenathayalan@marcus.com. For people who aren't familiar with the name, I'll just spell it out. It would be rdeenathayalan@marcus.com. We have segregated the webinar session into three components. Initially, I'll be talking. Initially, I'll be talking about the components of cost of capital, and secondly, I'll be discussing about the calculation of WACC for GCC countries, and as a third session, I'll be discussing about the cost of capital for private firms. Let's move on to the first part of the webinar, the components of cost of capital. This is the basic overview for computing the WACC. It primarily consists of two components, the cost of debt and the cost of equity. And this from here you can see that the cost of debt can be inferred from the explicit returns. The debt of a company could be occurring in three ways. One, it could be publicly traded, and two, it could be rated by some rating agencies, but the debt would not be ideally trading. And three, you may never know the rating of the debt, nor would it be publicly traded. This would be the case for most private companies. And the various ways in which the cost of debt can be calculated is, in case if the company is publicly traded and the debt by themselves could also be publicly traded, probably in the case of bonds, what you can do is you can go to the yield of the bond, and from there you can infer the cost of debt. But unlike this scenario, wherein the debt markets are not that much developed in the GCC countries, we need to look for alternative ways. One is the case wherein the debt is ideally rated. This usually happens for most of the big companies when they want to lower the cost of capital. What they do is they initially go to the rating agencies and get their debt rated. And this debt is rated based on a variety of financial ratios, such as what is their debt level with regard to the asset capability, how much of the interest payments occur as a percentage of income, which ideally is measured as an interest coverage ratio. And based on this debt rating, we can ideally compare this rating with those of the debt which actually trade and are also rated. From here, we can compute the debt spread, and from that, we could infer the cost of debt. And for companies, private companies, wherein the debt is neither traded nor publicly traded, what we can do is we can ideally pull up the financial statements of the companies, see how much of interest is paid on the debt, and from there we can easily infer the cost of debt. Let me go to the next slide, which ideally walks through some of the calculations which I mentioned. These are the three ways. One is the yield to maturity approach, the ratings approach, and the interest rate paid. The first YTM approach, or yield to maturity approach, is the most basic one, wherein the debt of the company is publicly listed and it's trading. Let's say the company has outstanding debt of Saudi riyals 100 million and it has a coupon rate of 5%, and the debt ideally matures in 10 years. And currently the debt is trading at 98 Saudi riyals. For this, simple calculators are available, and we can ideally easily calculate the yield to maturity. And from the yield to maturity, what essentially we need to do is we need to account for the tax factor. Let's say the marginal tax rate for the company is 6%. And for whatever the debt the company has taken, the interest payments offer a tax shield. So what we essentially do is we reduce the cost of debt, or ideally we account for the tax rate or the tax shield component as 1 minus t factor. So this being the 5.26 being the yield to maturity, we multiply it by the tax factor 1 minus t to get the cost of debt. This is the most basic approach to compute the cost of debt. However, most of the companies in GCC don't have their debt listed, or they are not actively being traded. For those companies, what we suggest is the ratings approach. In ratings approach, we have two primary components. One is the actual ratings approach and another is the computed rating approach. For the actual rating approach component, the debt is ideally rated by a reputed rating firm like Moody's or S&P. Okay. And for these companies, what we can do is we can compare the publicly traded yield of, say, triple B rated bonds, and we can see where exactly the rating of the company is. On a comparative basis, we can infer that the cost of the yield or the bond yield is 5%. From here, the calculations are almost the same, and we could ideally do it. This is the actual method. In computed method, what we do is this is for companies whose debt is not rated. So what we essentially do is we try to infer what would be the rating based on certain financial ratios. One such ratio is interest coverage ratio, which can be computed as interest expense by EBIT or EBIT by interest expense. So this ideally says the capability of the firm to service their debt. And based on that, we have a multiple chart which is publicly available, and that we could infer the ratings. Once the ratings are being inferred, it again becomes a simple process. But again, this is marginal. These are for companies for whom the debt is rated. But ideally, in GCC scenario, most of the companies which we try to evaluate, they don't have their debt either as publicly traded commodity, or probably their debt wouldn't be ideally rated by any of the rating agencies. For those companies, what we can do is we can just go to their financial statements and try to infer what is the interest charge incurred. And with that, what we can do is we can compute the total debt. Now, this total debt component will include the bank debt, the loans which they have taken, any leases, etc. And cumulatively, we need to sum it up, and that will yield the total debt. So from here, we can see the interest charge as a component of debt, and from that, we can easily calculate the cost of debt. So when we have the cost of debt, one part of the WACC is over. So the next part will come as the cost of equity. Unlike the cost of debt, the cost of equity is not explicitly stated in the form of interest payments. So the cost of equity is more like an implicit return which the investors expect. And this cost of equity can be, there are a variety of ways. Primarily, the most dominant model which is used to compute the cost of equity will be the CAPM, or capital asset pricing model. The other models which are in vogue is Pharma French factor model, which accounts for the size factor, whether it's a mid cap, large cap, and based on the size of the company, a premium is allocated. And the other factor in Pharma French is the one is the market cap, another is the book value. Depending on the book value too, we allocate a factor premium. The third approach is the build-up approach. Build-up approach is nothing but you build it by block. You take the bond deal, which is and then you add consecutive premiums. Here, the premiums could be because of variety of premiums could be included. It could also include the premiums which have been stated in the Pharma French model. So the premiums could be based on the liquidity factor, based on the market capitalization factor, based on the control factor, whether uh, the investor ideally have any control, or based on that we can allocate a premium. Let's look at some of the challenges in computing the cost of equity. The first line states the CAPM equation, which is nothing but the cost of equity calculation. Ideally, what it states is any investor, equity investor, he demands a premium for his equity component in his investment. So what he essentially does is, apart from the risk-free rate, he also requires some sort of additional premium to bear the equity risk. So this is given by the CAPM equation. And some of the challenges which the analysts face in computing the cost of equity is, one, a risk-free rate. This is the key starting component for most of the calculations. And ideally, since some of the GCC countries in particular don't have sovereign bonds. For example, in Kuwait, we don't have sovereign bonds. And even in cases where the government does have sovereign bonds, there could be a risk of default. For instance, in 2008 and 9, after the financial crisis, we had the Dubai debt crisis, wherein some of the companies backed by the Dubai government had to postpone their interest payments. So the government debt is not like totally risk-free over here in GCC, and they could have some component of default risk. So these two components make the calculation of risk-free rate a challenge. And the second challenge which we face in KPM is equity risk premium. This is the premium which the equity investors demand. And the challenges faced here is, one, the historical equity returns could be negative. Like for instance, after peaking in 2008, most of the markets suffered a heavy fall, and some of the markets are yet to scale back the peak. So if you try to see how much of equity returns have been provided in the past 7 years, say from 2008 to 2015, the returns could be negative. So this is like doesn't reflect the true picture of the equity risk. So when we try to account for the equity risk, we can't just like that take the equity returns, because the returns are going to be negative. And also one of the other major challenges, lack of data. Uh, Most of the data which is available in financial vendor sites like Reuters or Bloomberg, they don't have much of historical data. At best, the data could span for maybe 10 years or 15 years. And 15 years data is like too short when we consider the financial history. Like say compare it with the mature markets like US, wherein we have data right from 1930s and stuff. So the ideal thing is, due to lack of historical data, there could be significant estimation errors in computation of equity risk premium. And the third component of challenge is the beta calculation. Since most of the emerging and frontier markets are still illiquid, most of the stocks, they don't trade on a daily basis. Like they could suddenly see a spurt in volume in a particular week, and maybe in the next few weeks they could register no volumes. And this ideally, distorts the calculation of beta. And again, even in the calculation of beta, lack of data availability is a problem. So these are some of the challenges which we face, especially in computing the CAPM in frontier and emerging countries. So now that I have given a brief overview about the various components of cost of capital and the challenges have been enumerated, we'll try to see how exactly we can go about calculating the cost of capital for GCC countries. First, let me give you a brief introduction about risk-free asset, because this is going to be the foundation for any of the calculations which is going to happen for a corporate finance professional. Uh, when we say a asset is risk-free, what we essentially mean is the actual returns provided by the asset is totally equal to the expected returns. If the asset returns ideally equals the expected returns, we say the asset is risk-free. But however, in most instances, and the most asset classes which we come across, this is not the case. The expected returns could actually vary from the actual returns which we have seen from the asset. And in financial lingo, we measure risk as a variation in returns. So most of the assets which we normally encounter are not risk-free. And these are some of the characteristics of a risk-free asset. One, they should not suffer a default. Like if we say that in 6 months' time, this asset is going to provide a return, the asset should be viable till that such time. Maybe the asset could be providing interest, or even the principal could mature in probably 1 year time. Within this time frame, no fundamental mishaps should take place, and the asset should have a fundamental underlying, as in the asset could actually provide the interest as well as the principal after the said time. In most of the cases, we'll be incurring only private corporation assets or government assets. And ideally, most of the private corporations have some component of default risk. So ideally, we go in for government assets. And even in government assets, there could be a component of reinvestment risk. When you say reinvestment risk, let's say a government bond for 2 year period uh, ideally gives coupon semi-annually at 3%. Okay, and this is going to yield you a interest component in 6 months time of 3%. Okay, and what happens is, only if the coupon rate, if you're able to invest at the same 3%, you'll be getting the yield to maturity as stated in the prospectus. Otherwise, what is going to happen is you may incur a lower rate of return depending on the prevailing interest rate, or a higher rate of return depending on the prevailing interest rate. So to ideally overcome the problem of reinvestment risk, we usually go in for zero coupon bonds. When you say zero coupon bonds, these are the bonds which ideally don't pay any interest in the intermediate term. Like, let's say if it's going to be a 5 year bond, the bond doesn't pay any interest in the intermediate term. It's going to pay only the principal amount at the end of 5 years, along with the embedded interest component. So these type of zero coupon bonds instruments typically suffer from zero investment risk. And also, since if the government has the if it's the government entity which has issued the zero coupon bonds, they are not going to suffer from any default risk too. So ideally, what we can consider as a risk-free asset is a government issued bonds which ideally have the zero coupon component rate. Okay, and the third is consistency principle. What exactly we mean by consistency principle is, in case if you want to discount the cash flows, you could either discount it at the real rate or nominal rate. A nominal rate usually has a component of inflation factored in. So ideally, when you project the cash flows, we need to make sure which of the cash flows we are projecting. In case if you are projecting nominal cash flows, you should take the nominal rate. And in case if it's going to be real cash flows, you go in for real rate. Nominal rate is the usually the one which most of the analysts do, factoring in the inflation. And for nominal rate, the risk-free asset would be the US usually 10-year treasury yield for a mature market. And in case if the analyst is working on some frontier country wherein the inflation is very high and volatile, uh, forecasting the or projecting the cash flows in nominal rate, in nominal terms, wouldn't be effective because the inflation is going to be highly volatile. So in those cases, to better arrive at the valuation, most of the analysts usually forecast the cash flows in real rate. So since the cash flows are in real rate, it is imperative that you discount it by a real rate, real discount rate. And this, for computing the real discount rate, you need to take in the treasury protected, I mean, inflation protected treasuries. And one of the problem is, this inflation protected treasuries are widely traded only in the US markets. And most of the emerging and frontier countries where inflation plays a big role, they suffer from lack of treasury inflation protected securities. So how do we even go about finding a risk-free asset? That's the key challenge. And one of the ways in which we can overcome this hurdle is by using the mature risk-free asset. Like, let's say for Kuwait, we don't have a sovereign bond, and what we can do is we can take the mature country's risk-free asset. Like, let's consider US. It's considered to be a very stable country with strong fundamentals, and their government debt is usually considered to be risk-free. So, and they also have a 10-year zero coupon bond publicly traded, and let's say it yields 2%. Okay, now we have the mature risk-free rate, and to compute the risk-free rate for Kuwait, from this, what we do is we add upon the inflation differential for Kuwait country with US country. Okay, let's say the ideal long-term inflation rate in US is like 2%. And in Kuwait, the long-term inflation rate is projected at 4%. The inflation differential then would be 2%. So what we essentially do is we add this inflation differential to the mature risk-free asset, which is the US 10-year government bond, so of 2%. So ideally, we'll get a Kuwait risk-free rate of 4%. So similarly, we can compute the risk-free rate for all the GCC countries. And the next component would be the equity risk premium for GCC countries. The equity risk premium can be computed in three ways. One is from the sovereign rating, another is from the credit default swap spread or CDS spread, and the third is from the implied equity risk premium or ERP. I will run through each of the methods. In the first method's calculation of ERP based on sovereign rating, what we essentially do is we'll pull out the ratings from the rating agencies like say Moody's or S&P, and from here we'll be able to calculate the equity risk premium. What essentially this rating suggests is this rating provides a default risk component, and this is majorly for the government debt. So for the debt, we have a debt spread based on the ratings. Now this debt spread needs to be correlated with the equity component. And we have a specific formula for calculating the debt spread for the equity risk premium from the default debt spread. And historically, the financial literature states that the default risk for a debt is more tied to the equity risk component, and there exists a strong relationship between the two. So from the ratings, if we can compute the default risk spread, we'll be able to infer the equity risk premium. And let's consider the case of Saudi Arabia. We have given it in the table below. The equity risk premium for the US markets has been directly calculated based on the historical returns of equity markets, say from S&P 100 index and from the US government bond yield. And the equity risk premium at this time of calculation was 5.86. Now Saudi has been rated as AA3 by Moody's. And based on this rating, we can compute the default spread for government debt as 0.6%. And based on this, we can compute we can correlate the debt spread with the equity risk component to compute the ERP. And this calculation is usually widely publicly circulated. And more popularly, this was also calculated by the Professor Ashwath Damodaran, which he publishes in his own website too. So we also, in addition, publish the equity risk premium on a half-yearly basis for all the GCC countries, and it's hosted in our website. So people who are interested can log into Marmore website and have a look at this report for calculation of ERP. And over here, this default spread of 0.6% based on the rating AA3 for Saudi Arabia roughly translate into an equity risk premium of 5.6. However, as is the public knowledge, we may know that most of the ratings happen on a very time lag basis. I mean, the ratings don't happen on a real time basis, and there is a significant time lag between the deterioration of fundamentals of the government and the time it takes for the ratings to account for it and change their ratings. So what we can do is to overcome this time lag differences, we can go for credit default swaps. Credit default swaps are publicly traded and they are more real time. So whatever changes happen in the fundamentals of a government finances, they usually get quickly reflected into the CDS component. And from here again, we can infer the equity risk premium in more or less the same way. So let's say the 5-year CDS spread for Saudi Arabia is zero point 0.8, and for US by default it has a 0.2%. So the differential in the CDS spread will be 0.6, and this can be added to the equity risk premium of 5.8% to arrive at the equity risk component. So this is another way, and this is more real-time basis. So this is found to be more effective. And the third method to calculate the ERP is simply ERP. Over here, what we do is we assume that the markets are efficient and the stocks rightly reflect all the risk components. And from the stock market prices, the index level prices, we can compute the implied internal rate of return for the stock indices and use this return to compute the ERP. So now that we have seen how to calculate the risk-free rate and the ERP, the next our focus will be on the beta calculation. Computation of beta, as we saw, was a challenge in frontier and emerging markets because of the illiquid nature of the markets. So what ideally, usually how analysts do is they usually take the local market index as a proxy, and the stock returns or the company for which we are trying to calculate the cost of capital, the stock returns will be regressed over the index returns. And usually two methods are followed. One is based on the 5-year data, you take the monthly returns and compute it, or only if you have the 3-year data, you take the daily returns and regress it on the index returns. Ideally, for calculation, the analyst should go for global industry betas as they are a better reflective of the risk components rather than a local market, which could be highly illiquid. But usually, in most of the scenarios, this beta value is often obtained from a financial data vendor such as Reuters and Bloomberg. Uh, the next, the capital structure. We saw that in the initial slide, there is a component for cost of debt, and we have the cost of equity on the other hand. And these two components, once we have, they have to be taken in proportion according to the capital structure. Ideally, we need to go for the target capital structure. This is because the market value of the equity could be drastic in times of a bull market, and this could ideally distort the capital structure. So one, if they have access to the company's management, it's better to get the target capital structure as these are considered to be more stable rather than the market value for capital structure, which could vary depending on the market conditions. So this is the WACC summary which we have computed based on the assumptions of USD yield of 2.16% and a debt to equity ratio of 0.5 and a stock beta of 1. We initially calculate the risk-free rate, the ERP, from which, based on our assumptions of debt to beta of 1, we calculate the cost of equity. We have the cost of debt, and based on the proportion share of debt and equity in the capital structure, we arrive at the WACC. Over here, we have identified the debt to equity ratio as 0.5. And we've come to the final component of our presentation, computing the cost of capital for a private firm. The challenges over here for private firm is one, their debt are neither rated nor is it listed. And also they don't have a listed equity. So computation of beta is going to be a challenge. So what essentially you do for a private company is you initially identify the comparables. Like let's say the private firm which you want to evaluate is a cement company. So the comparable businesses which you take in is you take the listed cement companies. And what you do is you estimate the beta for the comparables. And the comparables could have multiple capital structure. Uh, let's say some of the companies could have a debt component of 70%, while some of the companies could have a debt component of 20%, while some of the companies may not even have a debt. So to account for all this, what we do is we unlever the beta of comparables. I will give you the formula for unlevering the beta in the next slide. And once you unlever, using this unlevered beta, you again lever the beta based on the capital structure of the private firm. So this is basically the essential flow chart. I will walk through with the example and with the numbers so that you can better grasp the concept. Over here we have this is a fictional scenario. Let's say the firm is ABC. It's a private company operating in cement industry, and it's located in Saudi Arabia. So what essentially we do is we pull out the comparable companies. Since the business is operating in a single sector cement company, we pull out the comparable listed cement companies. Let's say the comparables are Saudi Cement Company, Arabian Cement Company, and Yanbu Cement Company, and they also have similar revenues. So what we do is we pull out the debt to equity ratio for the comparable companies and the beta, which is usually provided by a financial vendor such as Reuters, and we average the debt to equity component and the beta. This will be the levered beta, and this will be the average debt to equity. And for our private company, we have assumed like uh, the target debt to equity is 30% and the cost of debt is 5.5%, 5.7%. This again inferred from the, let's say it's inferred from the company financial statements. And this gives you the formula for unlevering the beta of comparable company. So what you essentially do is we have the average beta of 0.51 percentage, and with this and the average debt to equity of 0.18, this is the formula we unlever it, which comes to around 0.44, and we again lever the unlevered beta for the industry based on the capital structure of the company ABC. So that has been included over here. And now this comes to be 0.57. So just by looking at the comparable beta for the industry at 0.51 and the levered beta for our company 0.57, we could infer that the company is slightly risky. This is because of the average debt to equity being a little higher in the case of our concerned company ABC rather than the industry average. So once we have the levered beta, we can substitute that in the CAPM equation. This is again the risk-free rate, the country risk premium, the beta, and we calculate the cost of equity. We have already assumed the cost of debt based on the financials. And here what we do is we weigh in the cost of debt and equity in appropriate proportion according to the capital structure, and we arrive at the cost of capital. So this is the way in which we can compute the cost of capital for a private firm. Now this brings us to the end of our presentation. Uh, and just before I end the presentation, just a word of caution. We have widely seen that multiple analysts use a variety of WACC, despite the principle for calculating the cost of capital being same. This is so because the cost of capital is quite dynamic. It depends a lot on the market factors which keep changing on a day-to-day basis. And the cost of equity is also subjective. We saw multiple ways to calculate the beta. It could be either due to the taking 5-year data on a monthly basis or considering returns, daily returns on a 3-year basis. So these factors could slightly alter the calculations from analyst to analyst. So what we essentially suggest is we have two handy tools called sensitivity analysis and scenario analysis. So what we can ideally do is once we have a WACC in place, we could maybe increase WACC in steps of 50 bips and decrease WACC in steps of 50 bips and arrive at a range of values and see how exactly it could impact the valuation. This would provide a more broader picture of what exactly is the risk involved in valuing a company. So with this, we come to the end of the presentation. Now we've opened the floor to questions. Okay, we have a question from one of the participants. The question is, how do you calculate the weight of debt and equity when projecting cash flows for 5 years? Do you take the average weight? The answer for this would be one is if you have access to the management, you can ideally ask the management for the ideal target structure of the capital. You can get the capital structure from the management and what exactly have they set it as a target. Maybe the management at the time being could have a debt of very low debt of 0% or 5%, but maybe in the next year they plan to take on say 30% of the debt, or raise the optimal capital structure to the debt component being 30%. So if you have the management estimates, that would be the ideal scenario. Otherwise, what you can do is you can take the market values as available and take it as a average weight. So the best way is like if you have access to the management, get them from the what would be their target capital structure. Or if you don't have access to the management, the ideal thing would be to consider the market weights. Okay, the next question is, let's say the company is not listed. It's only going to be a project. And in case of the project, what could be the ideal target capital structure? In this case, the solution is much more simpler. Since it's only a project, ideally people should have a definite capital structure for completion of this project. So this project could be based upon the optimal capital structure, which initially at the initiation of the project, the management should ideally have something in that mind. So in that case, for the project, you can consider any optimal structure. Uh, so let's say if the project is going to be a road development project, and this company is not a listed company, but it's just a single project which you need to evaluate. So what you can do is you can compare listed firms which are in the business of constructing roads. Okay, and you can try to get the see the what essentially is their ideal target capital structure for those companies which are in the businesses of road construction, which is similar to your project. So in that case, once you get the target capital structure for all listed road companies, ideally you could consider this to be the target structure for your project too. So in this way, you can overcome the challenge of target capital structure. Uh, Yes, this is just a follow-up of the same question. Do we use the target weights or current weight? In any ideal scenario, if you have access to the management and if you have any target weights, it's better to use the target weights. And in case if you don't have access to the management and if you're not sure of the target weights, it's better to go with the current weight. Only when in a scenario wherein you don't have target weight. And we have next question. What would be a terminal growth rate as well as WACC for what would be a terminal growth rate as well as WACC for high inflation country such as Egypt? Okay, since this presentation is mainly concentrated on cost of capital, we'll restrict only with one half of the question and let's not deal about the terminal growth rate. With regard to the back question, he's asking what exactly will be my WACC for a high inflation country such as Egypt. Well, since we are covering only, we cover the GCC countries over here, I wouldn't be able to pinpoint on a particular rate for WACC for a high inflation country such as Egypt. But once you have the process in hand, like how exactly to go about computing the WACC, it wouldn't matter whether the country has high inflation or low inflation, or whether the country is Kuwait or Egypt. If you follow the same principles as shown in the PPT, you should be able to calculate a WACC. And there is one other question regarding what exactly should be considered as debt. The user has asked when there are many debts on the balance sheet of a company, such as some debts could be having floating interest rate, some would have fixed interest rate, and the maturity would differ. How do you exactly go about computing the KD? This is a good question because we have ideally discussed only about companies wherein which ideally has a single debt component. So in this case, wherein the company has multiple debt components, what essentially you can do is you can accumulate all the debt. Like the debt could be a fixed debt, bank loan, or a floating rate loan, or it could be in the form of money market loans. Whatever the debt is, you accumulate all the debt and you see how much of an interest does it incur on an annual basis, which you could easily get it from the financial statements in the income statement. So in the balance sheet, you accumulate all the items which have been classified as debt, even the short-term debt and the long-term debt. And the income statement, you see how much of interest expense has it occurred in a particular year, and dividing these two will give you the uh, cost of debt for the company, and this can be considered as a cost of debt, irrespective of the debt coming under different components such as floating rate or fixed rate. And there is one other question from one of our fellow participant. For the country risk premium, do we add it to the total ERP and multiply by beta, or just keep it out of the bracket? According to Damodaran, he adds the country risk premium to the ERP. For example, for Kuwait, he has the country risk premium, which is I saw. Ideally, what we do is, one is in the risk-free rate. You could add additional. Let's say you are considering the risk-free rate for Kuwait. In such a case, for calculating the risk-free rate of Kuwait, what essentially you do is you take the mature market risk-free rate such as US, and to that you add some component of risk factor, so that it ideally reflects the true risk component of a frontier or emerging country such as the GCC countries. So in that case, what you do is you add the risk premium to the risk-free rate, and you multiply the beta for the risk premium. And we should also be careful over here, because at times what we essentially do is, apart from the equity risk premium, based on the projects, you could have additional risk. Maybe there could be a risk of default. So all that doesn't get captured. That's where the pharma French model comes into play, wherein you had multiple premiums. So there is a slight difference wherein adding the risk premiums. So it all depends on what essentially you consider as risk-free rate. And there is one other question. uh, in using inflation differential, do you use IMF future forecast, historical averages, or current inflation? Since our valuation is like on a futuristic basis, it would be better to go with the future forecast. And again, inflation is highly volatile. So what essentially you need to do is you need to understand what exactly the inflation is being targeted by the central bank. And this inflation target is more a long-term number, and it's more reliable. So for calculating the inflation differentials, it's better to go with the country target rate for long-term inflation and on a futuristic basis. There is one other question. How do you capture risk in a low interest rate environment? Such as today's government have decreased interest rate to spur spending, yet the risk profile of the economy in comparison to the global economy has worsened. This is again a very good question. There could be a perception as in like, when you decrease the interest rate, you ideally what essentially you're doing is you're lowering the cost of capital. So ideally when you lower the cost of capital, you're going to increase the valuations are going to be higher. So where exactly does the risk get captured? One of the main thing is this low rate interest rate environment has this effect of ideally this is actually a symptom of a low growth environment with low inflation. So ideally, in the denominator, when the inflation is lower, the cash flow projections will also automatically lower because of low growth expectations. So this in way is a trade-off. The lower the interest rate, ideally when you project the cash flows also, you won't be projecting on a very optimistic basis at a very high growth levels. In the scenario of low interest rate environment, we all know that most of the developed countries have been the growth is very stagnant. So this would also affect the cash flow component, and thus it's a trade-off. And with this, we wrap up the webinar session. In case if you have any further queries, you could always mail us to us. Thanks to all participants for participating. Thank you.